You're listening to the REITE Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at thereiteclub.com. And now your hosts, Sarah Larby and Alfonso Salemi.
You know, it really just depends on the situation. Like, honestly, most real estate investors, you're probably, this is like going to be like kind of a family run business for the most part, or you in conjunction with like another, business colleague. It's probably going to be literally you guys being everything. Like, you'll be the officers, you'll probably be the directors, and you'll be the shareholders. And that's kind of it, right? Like, you're everything, right? But, could you have like other advisors and colleagues and people on your business team sitting in different positions within the corporation? Sure, you could. But I think people will be hesitant to do that in some respects, because a director and an officer, you can have liability, right? Like, if you make mistakes that are to a high enough level of, you've made a professional error or you've been negligent, then now they can personally be accountable, not just, it's not just the corporation that is accountable for whatever the debt or the issue is. It's the person themselves as well, because they unfortunately maybe acted negligently or just, didn't do something to the standard that they needed to as a director or officer, right? So most people will probably not want to engage in that role. Like, they won't want to officially engage in that role as an officer and director unless they're like actually going to be, owners probably in the privately held company. But to your point, having the coach or the teammates all involved, the advisors, all like at the ready, all, on retainers, or, just a phone call or an email away. I think that's your key thing, right? It's all back to that power team. Just having everybody ready to help you and give you the advice that you need will allow you to make sure you've got it set up properly. Decisions you're making are, calculated. You've tried to minimize as much risk in the decisions you make as you can. At the end of the day, real estate is an investment like any other. There's always going to be a risk. You've got to calculate the risk versus the reward. And hopefully you get the biggest return on your investment at the lowest risk, right? So there's always risk reward with it. It is an investment after all. But I think that team, as you put it, and having that group of advisors all together will be your best bet at properly scaling up, for sure, 100%.
Can you talk a little bit more about family trust? Because I'm starting to hear a little bit about this, but I think it's still fairly new in the landscape. So first of all, when you talk about a trust, a family trust that you would put real estate in, what exactly is that? How easy is it to set up? And why would I choose that versus a corporation?
Yeah, so a family trust, again, like a corporation, is a separately, it's a separate legal entity, right? It can exist on its own. And it's taxed on its own too, right? It receives different tax treatment than an individual and in a corporation, right? In Ontario, a trust can't own title. Like, you can't have a registered deed owned by a trust. You could have indirectly the trust be the owner of a corporation, and thus the beneficial ownership is a trust, but registered title can't be owned by a trust. The director of titles won't allow in Ontario trusts to be an owner on title, on registered deed, right? But beneficially, meaning the person who is the actual true owner of the property, not just who's on title, but the true owner of the property, can be a trust. And a lot of accountants are, like I said earlier, looking to use a combination of a corporate structure with a family trust to maximize people's benefits for tax planning, long-term planning, estate planning, all these various different reasons to, again, help probably minimize your year-over-year costs of paying tax to the government, but set you up in such a way to provide, other future benefits of just business planning. Like one example with a family trust is you could have your kid, like if you have yourself, your spouse, and your kids all as beneficiaries to the trust, there's different ways of the money coming out of the trust to pay for the kids' education that is now much more tax favorable than if you just, took it out and paid for the kids' education. RESPs, you can only really put so much money into an RESP for it to be like worthwhile from a tax point of view, like getting the different tax benefits of it, as well as like the government contributions that they offer in Ontario. So people will use trusts as an example to have money go in and flow out for things like kids' education, for example. So there's lots of different ways, but the trust is used very similar to corporation. It's there for like a reduction in tax and creating options and opportunities for the beneficiaries of the trust or the corporation to just excel their planning, right? If you do this, if you literally didn't do any corporate planning, you didn't have a trust, you didn't do any tax planning, you did nothing. You just did Alfonso individual person versus Alfonso planner and tax extraordinaire. The latter being the planner and the person who did corporate structure and trust planning and so forth, probably 9 times out of 10 is going to be way ahead of Alfonso the individual. Alfonso the individual, let's say he has he's taking out, he's got $1 million of value. Every year he makes $1 million, maybe that's a downgrade for you, Alfonso. I don't know. But let's say Alfonso had $1 million come to him every single year. Well, right off the hop, he's in the highest tax bracket, right? So personally, he's losing 55% of that $1 million. It's gone. If Alfonso, corporate planner and extraordinaire, has $1 million flowing through various corporations and trust, well, he's not paying 55%. If he keeps a bunch of that money all in the corporate level and the trust levels, he's paying only at those rates, which are significantly lower. He's only going to pay the higher personal tax rates at whatever he pulls out into his personal hands. So the latter is always going to come out ahead.
So if my understanding is correct, then, because I really need to get this clear for myself, so I set up a corporation. My corporation has title to whatever properties there are. Then I set up a trust, and whether I set them up together or one before the other, I'm not quite sure. But the trust then owns the corporation. Is that correct?
Yeah, you can have the trust as the shareholder in the corporation. Okay. Correct.
And then whatever, profits or because they own it, the revenue, whatever revenue that comes out of the corporation can go to the trust.
Yeah, you can have stuff flow between corporate, like if you had multiple corporations, all like similarly owned, you can do like intercompany, intercorporation dividends or transfers, whichever the accountant wants to call it, but they can move the money between those companies, those corporations, because they're similarly owned or identically owned. And then the family trust is no different. You could move money from a corporation up to the different family trusts. Same thing. They have preferential tax treatment the way they move the money around. So basically, it's not getting taxed. It's moving around to the various different corps and family trusts until it lands in a spot that's the most beneficial, as deemed by the accountant. And then hopefully the plan, if it's properly laid out with the accountant and the lawyer, will be you're paying as little as possible year over year with some sort of maximization at the end with an estate plan.
Thanks for listening to the REITE Club podcast and joining our community of real estate investors online at thereiteclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.